Good evening. Please come to IAS 34. What is IAS 34? Interim Financial Reporting. What is Interim Financial Reporting? Interim Financial Reporting is preparing financial report for an interim period. That means it is preparing financial report for a period which is less than 12 months. Why would a company require to prepare interim financial report? In some countries, there are laws. For example, if there is a listed company, it may be required to prepare quarterly reports or half yearly reports. In case an entity has taken a bank loan, bank may require it to prepare quarterly reports or half yearly reports and submit it to the bank. Or if you have taken investment from equity investors, private investors, venture capitalists, then they may require you to prepare interim financial report, and therefore the entity may be required to prepare an interim financial report. What is the benefit of preparing interim financial report? The information is more frequently available. In case there is no interim financial report, investors will get annual report. 1 year is a very long time in the corporate world. Many changes may take place during this 1 year period, and by the time the investor will get to know about it, it will be too late. Is it right? In 1 year time, what are the events that can happen in the life of a company? Buyback of share, issue of share, merger, demerger, sale of significant asset, bonus share, right share, share split, converting debenture into equity, okay, dividend paid, some segment is sold out. All this information, when will the investor get? After 12 months, if there is no interim financial report. So any company which prepares interim financial report, either because of requirement of the law or because of the voluntary compliance, then it must follow IAS 34. IAS 34 does not make it mandatory that an entity has to follow interim financial report. If you prepare interim financial report, then the recognition and measurement principle of IAS 34 will apply. Okay. So the objective of IAS 34 is regular reporting, more frequent reporting, timely updating the investor about what is happening in the company, and therefore he can take a timely decision about his investment. The need for reporting of financial and operating activities at regular intervals. Many jurisdiction authorities also require listed companies to submit unaudited interim financial reports. Like listed companies in India, SEBI requires them to prepare quarterly reports, even though it may be unaudited, but it has to be given so that the investors get more information on a timely basis. And in order to bring uniformity in such report, we need a standard. The standard will give you minimum components to be reported along with content, form and the recognition criteria. So what we are going to learn, what is the minimum requirement of the standard, what is the form in which financial statement should be reported, and the recognition criteria. Now the standard starts. The standard says what is an interim period. Interim period is a financial reporting period shorter than one full financial year. That means it is a financial report covering less than 12 months. Is every financial report which covers less than 3 months an interim period financial report? Every financial report which is of less than 3 months is not an interim financial report. The reason, for example, a company got incorporated on 1st of January. and it prepared its first financial statement on 31st of March. Will it be called an interim financial report? No. A company was following 31st March as its year ending date. It changed the year ending date to 31st December. So then the year in which it has changed the year ending date from 31st March to 31st December, it will cover a 9-month period. 1st April to 31st December. Will that 9-month period be covered will be called interim financial report? No, because it is a change in the financial year date only. So that will not be called as an interim financial report. What is an interim financial report? It means a financial report containing either a complete set of financial statement or a condensed set of financial statement for an interim period. So first understand simple version. IFR, interim financial report, is a financial report for an interim period. Interim financial report is a financial report for an interim period. This report can be prepared in either of the two forms. It can be a condensed financial statement or it can be a complete set of financial statement. What is the difference between the two? Condensed set of financial statement means the information that is required to be given is minimum, and complete set of financial statement is similar to what you prepare in what information you give in annual report. So this is one end, minimum requirement, condensed. This is another end, complete set of financial statement. Between these two extremes, condensed and complete, you can give information. Condensed is minimum requirement. For example, in case if you have to give information about share capital, you just write down share capital and the amount. You can just write inventory and the amount of inventory. You are not required to give the detailed version of raw material, finished goods, work in progress, stores and spares. Okay. Which will be preferred by the company, condensed or complete? Condensed. 1. Time required to complete is less. Second, cost and effort required to finish it is also less. Condensed is also preferred for interim period so that it can be prepared faster and you can present it to the investor as early as possible. If you prepare complete financial statement, it may take more time, and by the time you finish one complete financial statement, another interim period will get over. So they have compromised with detailing, but they have not compromised with timely updation. So what is given priority? Timely updation. Next is recognition and measurement. Do we have a separate recognition and a measurement principle in this standard? No. Whatever you have been doing for annual accounting, you follow the same recognition and principle for interim accounting also. So point number 3, in recognition and measurement should be done on a year to date basis. What is year to date basis? Underline. That is from the first day of the fiscal year to the given interim date. First day of the fiscal year means, let us say our financial year is April to March. So 1st April 2020 and my interim period ends on 30th September to 30th September. So first quarter I have already reported. In second quarter, I will see what will be the total amount to be recognized for both the quarters. And then any difference between second and first quarter will be reported in the second quarter. Is it right? Any difference between year to date figure and what I have already recognized. Like for example, depreciation. First quarter you provide for 3 months. Second quarter you calculate the depreciation for 6 months. And minus you have already provided. While calculating tax expense, in second quarter calculate total tax expense for both the quarters. minus tax expense for first quarter already recognized. That is called year to date basis. The purpose of year to date basis is that interim period together make annual report. In 4 quarterly interim report is equal to 1 annual report. What about accounting policies? Same accounting policy has to be followed, which you have adopted for annual accounts. If an entity does not comply with IAS 34, then the same should be disclosed. Okay, in the next paragraph number 4, accounting policy. In case if your financial statement, interim financial statements are not in compliance with IAS 34, then you have to disclose the same. Then some lines are repeated, don't worry. Accounting policy used for preparing interim financial report cannot be different from that adopted for annual reports. Keep this line in mind because while solving the question, I am going to use this line. Whatever policy you follow for annual accounting, yearly accounting, annual reporting purpose, you will follow the same principle for interim period also. The same accounting policy applied for annual financial statement should be applied in preparation of interim financial statement. To achieve this objective, measurement for interim reporting purpose shall be made on a year-to-date basis. Now come to this line somewhere below in paragraph 4 in your notes. Entity is not prohibited to make out interim financial statement without compliance of some IFRS. You can prepare interim financial report without complying with some of the IFRS. Okay. You can do that, but when you do that, you will not state that IFR is interim financial reports are IFRS compliant. You will state that interim financial report is IFRS compliant only when it meets the requirement of all the IFRS. Okay. So I'll repeat point number 4. You may not follow IFRS in interim financial report, all IFRS, but then you don't have to write that interim financial report is IFRS compliant. You will disclose interim financial report as IFRS compliant when all the IFRS have been followed. Now, there is a special issue in this standard, and that is calculation of tax expense. How do you compute tax expense for interim period? So there are some calculation involved here. First, I'll read this line, we'll analyze it and take few examples. Tax expense recognized is based on best estimate of weighted average effective income tax rate expected for the full financial year. So now there is a challenge here. What do you mean by weighted average effective annual tax rate? As you know, an entity pays tax for the full year. An entity pays tax for the full year. But if you are preparing quarterly reports, you have to make provision in the quarterly reports also. But you don't calculate tax liability on a quarterly basis. You calculate tax liability on an annual basis. So first step, what you will do, you find out the annual income. Let us assume 5 lakh. Then if there is any deduction, exemption, carry forward loss that you have to adjust, you adjust. For example, 1 lakh rupees. So this will give me taxable income of 4 lakh. and then you calculate tax liability. Tax liability suppose is 30%. Step 2, tax. So this will come to 1,20,000, correct? So what will be my effective annual tax rate? Weighted average effective income tax rate. 1,20,000 I will take and divide by 5 lakh. This 5 lakh. So this comes to 24%. This is called weighted average effective income tax rate. What is the use of this 24% now? Suppose I come to quarter 1. In quarter 1 my profit before tax is 2 lakh. So I will provide for tax expense taking 24% of 2 lakh, 48,000. So therefore my profit after tax will be 1,52,000. So this is the weighted average tax rate. But the same thing I will not do in the second quarter. In second quarter what we will do? We will again revise our estimate of weighted average tax rate. Okay. So now suppose we are in the second quarter. Again we'll estimate annual income. Will it remain same or it may change? It may change, because now I think my annual income will be 6 lakh. Less deductions, exemptions will be say 1,20,000. So my net taxable income will be 4,80,000. And then I will calculate tax at the rate of say 30%. How much is that? 1,44,000. So my weighted average effective income tax rate 1,44,000 divided by 6 lakh. Again 24%. Okay, we'll make a small change. We'll make deduction 1 lakh only. 5 lakh. 1,50,000. So is it 25% now? So my weighted average tax rate is 25% now. Previous quarter it was how much? 24%. We have already provided for 24% in first quarter. In quarter 2, I will calculate like this. PBT. Suppose PBT of second quarter is expected to be 2,50,000. How will you calculate tax expense? You will first calculate 25% of, not 2,50,000. 2,50,000 and plus 2 lakh of the previous quarter. This should be my cumulative tax expense for both the quarter, minus already provided in the previous quarter. Minus already provided in the previous quarter 48,000. How much? 64. Final answer. So this will be my tax expense of this quarter, and therefore my profit after tax for the second quarter will be 1 lakh. Is it 185,500? Yes. Okay, now we'll solve one question. This will be there in your book nearby only. Question number 2. Question number 2. An enterprise reports quarterly. At the end of quarter 1, estimate of pre-tax annual profit was rupees 6 lakh. And the aggregate of deduction from GTI under tax law was estimated at rupees 1 lakh. So this is my annual estimated figures. 6 lakh is income, 1 lakh is deduction. So taxable income is 5 lakh. At the end of quarter 2, estimate of pre-tax annual profit was 6.3 lakh. An aggregate of deduction from GTI under tax laws was estimated at rupees 84,000. So 6.30 minus 0.84. 5,46,000. This is my estimated income for total year in the second quarter. The pre-tax profit is 1.2 lakh and 1.3 lakh in quarter 1 and quarter 2. Tax rate is 30%. Compute the profit after tax of the each quarter. So what we will do, first we will calculate check in your book. First we will calculate what is my annual tax liability at the end of quarter 1. My annual tax liability at the end of quarter 1 is 30% of in bracket 6 lakh minus 1 lakh. That comes to 1.5 lakh. And your tax liability is 1.5 lakh, annual income is 6 lakh. So weighted average tax rate is 1.5 divided by 6, 25%. Tax expense for quarter 1 is 25% into 1.2, 0.30 lakh. Is this understandable? First quarter is always easy. When you come to second quarter, again you have to first revise your estimate of weighted average tax rate. Tax liability of the second quarter, annual estimated tax liability of second quarter, 30% of annual income 6.3 lakh minus deduction 0.84. So that comes to 1.638 lakh. Weighted average tax rate in second quarter estimated will be 1.638 lakh, that is my total tax liability, and divide by 6.30, that is my estimated total income, that is called 26% weighted average tax rate. Now my question is how to get the tax expense of quarter 2. Take the revised weighted average tax rate 26% into, you add the total income of both the quarter 1 1.2 plus quarter 2 1.3. So this will give me cumulative tax expense minus previous quarter 0.30, this figure. So the net amount will be 0.35 lakh. And then below this calculation, you can show the small P&L account, PBT 1.2, 1.3, tax 0.3, 0.35, so profit after tax 0.90 and 0.95. Okay. One more practice. Check for this question. Is it question number 3 below? Yes. Question number 3. An enterprise that reports quarterly earned rupees 1 lakh before tax at the end of quarter 1 and rupees 1.5 lakh at the end of quarter 2. The annual PBT estimated at the end of quarter 1 was rupees 4 lakh, and that at the end of quarter 2 was rupees 5 lakh. The company had a carry forward loss of rupees 1 lakh. The applicable tax rate is 40%. Compute the profit after tax for the quarters. What is the difference in question 2 and question 3? Previously they had given deductions, now they have given carry forward of loss. While estimating the weighted average tax rate, we will also take into account the carry forward loss also. So check the calculation. I will explain line by line. Answer is printed in your book. The annual tax liability estimated at quarter 1. Come to quarter 1. Your tax rate is 40%. Tax rate 40%. Annual income is 4 lakh and deduction is 1 lakh. So my tax liability for the full year is 1.2 lakh. 1.2 lakh divided by 4 lakh. At the end of quarter 1, I was estimating my average tax rate to be 30%. Okay. So therefore, tax expense for quarter 1, take this tax rate 30% into 1 lakh. How much is that? 0.30 lakh. Quarter 1 is easy. But when I go to quarter 2, I have to revise my estimate first. In the quarter 2, my income is 5 lakh annual estimated and deduction is 1 lakh. So 5 minus 1, 4 lakh into 40%. So my estimated tax liability for the year is 1.6 lakh. Weighted average tax rate expected in quarter 2 is 1.6 lakh divided by 5 lakh is equal to 32%, right? Tick mark. So therefore tax expense for quarter 2 will be cumulative tax liability of both the quarters. 32% of first quarter income 1 lakh plus second quarter income 1.5 lakh minus tax expense of the first quarter 0.30 lakh. So is it 0.5 lakh? Tick mark. So how will your P&L account look like? Like this. PBT 1.5, tax expense 0.30 and 0.50. Therefore profit after tax 0.70 and 1. Check this question also, or is it the same one? This question now. Question number 4. An enterprise reports quarterly, estimates an annual income of 10 lakh. Assume tax rate on first rupees 5 lakh is at 30% and on balance income at 40%. So this time we have to find out the tax liability using slab system. 0 to 5 lakh tax rate is 30%, more than 5 lakh 40%. The estimated quarterly income are rupees 75,000, rupees 2,50,000, rupees 3,75,000 and rupees 3 lakh. Calculate the tax expense to be recognized in each quarter. Now in this question, one good news is that the annual income 10 lakh figure is not changing. There is no deduction, exemptions, carry forward of loss. So I can first calculate the weighted average tax rate for the entire year, and this will be applicable for all the 4 quarters. Oversimplified question. So calculate tax expense. First 5 lakh at 30%. How much is that? 1,50,000, tick mark. 40% for remaining 5 lakh. 2 lakh, tick mark. Total 3,50,000. 3,50,000 divide by 10 lakh. How much? 3,50,000 divided by 10 lakh. 35%. So 35% would be your weighted average tax rate for the year. And then you compute the tax expense of each quarter. First quarter 75,000 into 35%. Check, is it right? 26,250. 35% of 2,50,000. Tick mark. 87,500. 35% of 3,75,000. 1,31,250. And 35% of 3 lakh, 1,05,000. So total is 3,50,000. Checked. Okay, try one more. Question number 5. To comply with the listing requirement and other statutory obligations. Question number 5. Quaker Limited prepares interim financial report at the end of each quarter. The company has a brought forward loss of 700 lakhs under tax law, out of which 90% is eligible for set off as per the recent verdict of the court. So I will not set off entire 700 lakh. I will set off only 90% of 700 lakh, which is 630 lakh. That has attained finality. So 630 lakh you will deduct. Company has reported quarterly earning of 700 lakh and rupees 300 lakh respectively for the first 2 quarters of financial year 2013-14 and anticipates a net earning of 800 lakh in the coming half year ended March 2014, of which rupees 100 lakh will be the loss in the quarter ended December 31st, 2013. Tax rate is 30% and this time one more variable, 10% surcharge. So if tax rate is 30% and surcharge is 10%, it means total tax rate will be 30 plus 10% of 30. How much is 30 plus 10% of 30? 33%. So what is the new thing they have added in this problem? 10% surcharge. Don't worry, you make it 33% tax rate. 30 plus 10% of 30, 33%. Calculate the tax expense of each quarter. So let us discuss first. What is my annual income? What is my annual income? 1,800. And then what is your loss that can be set off? 630. So what is the taxable income? Taxable income will be how much? 1170. So tax liability at the rate of 33% I will take, including surcharge, 386.10. So my weighted average effective tax rate 386.10 divided by 1800, how much? 21.45%. Sure? 100% sure, or you have copied from the notes? 21.45%. Now how many quarters we have in this question? 4. So what is your PBT? PBT is 700 lakh, 300 lakh, loss of 100. How did you get 900? This is not printed anywhere. The total income of last 6 months is 800, out of which third quarter loss is 100. So the loss of the third quarter is 100, means profit of the fourth quarter will be 900. The total of these two is 800 in the problem. This is given, this is balancing figure. Tax expense at the rate of 21.45%. Calculate. Tick mark. Is it right? Second one. Tick mark. Is it right? 21.45. And what about this? 193. Is it right? So tick mark all the answer which you have understood. Write few homework today. Question number 1, write down homework. Question number 6, write down homework. Question number 7. Total 7 question I have put there for tax problems. 4 I have done. 3 you will do, okay, as homework. Next is seasonal, occasional or cyclical revenue. How to deal with that? In interim financial report, this is a big challenge. A company is selling woolen garment. Most of the sales are in November, December, January. And you are preparing your first quarter interim financial report, which is April, May, June, peak summer. What would be the sales of woolen garment? Not zero, but very low. People who go to America will buy. People will go to Europe will buy. Okay, but such people are very less. Rest of the population will not think of buying woolen garment in April, May, June. Yes or no? So sales will be low, profit will be low. There can be loss also, because your operating cost, which includes lot of fixed cost, may be much more than the sales also. So in case if you show losses, management would think this loss is only hypothetical, because for the entire year I am going to make profit. I am going to make sales in the third quarter, fourth quarter. Why not? Why not book the revenue equally in all the 4 quarters, or at least some revenue which I am going to earn in the third and fourth quarter? Let me prepone that revenue and recognize it now. Can you do that? Not allowed. Or take a reverse calculation, reverse situation. You are an air conditioner company, cooler, fan, AC. First quarter sale is very high, April, May, June. People will buy a lot of cooler, AC, fan. But what about the third quarter, when there is a peak winter season in India? November, December, October, November, December, less sales. So company, what they will like to do, instead of showing loss in the third quarter or the fourth quarter, why not to shift some revenue to the third or the fourth quarter? Can we do that? Just think, will you do the same thing for annual accounting? In the starting 2-3 paragraph we have discussed, follow the same accounting which you will follow for annual accounting. So in annual accounting, I am not going to do that. I am not going to shift the revenue of this year to next year, or prepone the revenue of next year to this year. Not allowed for interim period also. What you can do, you can give a disclosure. You can give a disclosure. What about occasional revenue or cyclical revenue? That means they don't occur throughout the year. They may occur once in a year, like dividend received on equity share. Seasonal revenue we have discussed. So dividend received once in a year, or royalty received for certain period only, rent received for certain period, grant received in a certain period. So occasional revenue and cyclical revenue, will you apportion it equally over all the interim period, or will you recognize it as an income of the respective interim period? Respective interim period. What cannot be allocated for annual accounting purpose, you can't allocate it for interim period also. So one example on occasional revenue, there is a example, question number 8, problem number 8 or 9, just check. Is it 9? Yes, 9. Question number 9, tick mark. Understand all these basic things first. X Limited holds equity share worth rupees 1 lakh in Y Limited. Y Limited is doing well and is sure to declare dividend for the coming year. Very good. While preparing the interim financial report, X Limited recognizes pro rata dividend income which has not actually been received by it. Amazing. Is the treatment right? We are in the first quarter, April, May, June. Normally the companies give the dividend in the second quarter, because AGM normally is held in India around June, July, August. Okay, and then the dividend is paid in July, August, September. He knows, this company knows that I am going to receive the dividend in the next quarter, but it wants to recognize pro rata dividend in this quarter also. Can we do that? The answer is no. It is an occasional revenue and it will be recognized only when dividend, in case of dividend, right to receive the dividend is established. Right to dividend is established only after dividend is approved and declared in the AGM, and therefore you will write it is not appropriate to recognize dividend income even though it may be sure of declaration. And now one more question, number 8. A Limited expects to receive dividend income of rupees 100 crore on its investment in quarter October to December 2021. It proposes to recognize rupees 25 crore dividend income in interim financial statement of each quarter. Similar problem. Is it justified? No. It is an occasional income and it should be recognized only when the right to receive the dividend is established, and that will take place somewhere in third quarter. Entire 100 crore rupees will be recognized as income of the third quarter and it will not be apportioned equally over all the 4 quarters. Right? Now paragraph number 7. Paragraph 6 was about seasonal, occasional, cyclical revenue, and paragraph 7 is about costs that are incurred unevenly. What is unevenly? It may not be equal in all the 4 quarters, all the interim period. For example, training given to staff in the first quarter, because the income tax act changes in the first quarter, indirect taxes changes in the first quarter, many Ind AS or IFRS or new accounting pronouncement becomes applicable from the 1st April. So what companies do in India? Training. Will they give training in second quarter, third quarter and fourth quarter also? No. That time they will be busy in making money. Okay. Second, third quarter in India is revenue generating activity for the professional. So they will give training in the first quarter. Can they apportion it to other quarters also? No. Yes. Why? Get benefit. Will you do the same thing for annual accounting purpose also? No. So you are not going to postpone the recognition of cost. Reverse the example. You are planning to provide training to the staff in the fourth quarter. Will you recognize a portion of it in the first, second, third quarter? No, because that is even more dangerous. There is no obligation right now. There is no past event. There is no present obligation. One more example, repairs and maintenance. You don't incur repairs and maintenance every quarter. It is incurred either in the first quarter or maybe in the last quarter or in some particular period of the year. Every company has the repairs and maintenance policy. It will be recognized with respect to that interim period only. Here what you do, keep one principle in mind. Will it be allowed to be deferred or anticipated for annual accounting? If the answer is yes, then you can defer or anticipate in the interim period also. And if it is not allowed to be deferred or anticipated for annual reporting, it will not be allowed to be deferred or anticipated for interim reporting. So what you can do in annual reporting, you can do in interim period. What you are not allowed to do for annual accounting, you will not do it for interim accounting also. Now we'll test whether you are attentive or not. A small question which has 8 sub parts, and you have to only answer whether the given treatment which management wants to give in their books, can it be allowed by this standard? Your client is a listed company. It is in the process of preparing first quarter account as required by its stock exchange. So we are in the first quarter. Okay. That means we'll assume we are in the month of April, May, June. 30th June is our quarter ending date. Advise your client in the following position. 1. Training expenses incurred in the first quarter. Very good. Will be allocated equally over the 4 quarters. Will be allocated equally over the 4 quarters because the benefit is spread over the entire year. The same question I had asked you. So the answer is no. Training expenses will be recognized as expense in the first quarter only. It is not allowed to be deferred for annual accounting purpose also. It will not be allowed to be deferred for interim period also. Expenses once received by the employee, he can leave. So there is no control. You cannot carry it in the balance sheet. Question number 2 for you. Training expenses expected to be incurred in the last quarter. Very good. Will be estimated and equally allocated to all the 4 quarters. Now this is absolutely not allowed because right now there is no present obligation. There is no past event also. So it does not fit into the definition of a liability. Not allowed. So this statement is not correct. Point number 3. A donation of rupees 5 million is expected to be made in the second quarter. Provision will be made in the first quarter. What is your answer? No past event? It is not a question of no past event that you can say, but it is a specific expense related to second quarter only. So it should be charged respect to the respective second quarter only. And even you can say that right now there is no present obligation. Who knows? You may change your mind and may not pay the donation. Point number 4. Since historically there have been an immaterial variance between budget and actual. Immaterial variance means what we budgeted and what has actually happened. There is very minimum difference between the two. Depreciation charge each quarter will be determined by the budgeted figure. Can we prepare financial statement where depreciation is based on budgeted figure rather than actual figure? Have you ever heard such financial statement? Will this be allowed for annual accounting purpose? No. So therefore this is also not correct. Your answer will be, it will be based on actual asset and actual calculation as per the respective standard and the law. Now this point number 5 is difficult. E. Incentives are provided to customers if they purchase 1 million kg of urea on an annual basis. So if you purchase 1 million kg, you will get incentive. That 1 million target is given for the full year. And you are in the first quarter. It is expected that at least 30 customers would be able to achieve this target before the end of the third quarter. 30 customers would be able to achieve the target before the end of the third quarter. No provision is made for incentive in the first quarter. Since the client believes that the provision has not yet been fructified. Fructified means that fructified. It is not yet over. Okay. It is not yet, this provision is not yet ready for recognized. My question is, dear students, should we make provision for incentive in the first quarter or not? Why you should make? No customer so far in the first quarter has completed that 1 million kg urea target. 30 customers are expected. They must have purchased some in the first quarter also. And if they have purchased in the first quarter, there is a condition that they will get the incentive. We are, for 30 customer, we are sure that they will be able to achieve the target. Therefore, you have to make a provision for incentive for this customer, 30 customer, based on whatever they have purchased in the first quarter. So here there is a present obligation, because the probability that you will pay is more than 50%. Here there is a past event. You have sold the goods with a condition that in case if you achieve the target, we'll pay you some incentive. And there is a reliable estimate possible. Outflow of resources will take place. So right there, it is a present obligation arising out of past event. Outflow of resources is probable. Reliable estimate can be made. So in this example, you have to make the provision. Same thing can happen for bonus to employees also. If the employee has rendered services and you are going to pay him bonus in the fourth quarter, then you have to recognize in the first quarter also some portion of that bonus. So incentive, bonus, which are payable normally on annual basis, they are anticipated. Okay. Point number 6, 70% of client revenue comes in the second quarter. So there is a huge variation in the revenue pattern of this company. Maybe because it's a seasonal business. The client wants to spread this revenue to all the 4 quarters. Else the quarterly accounts will fluctuate significantly. So just now you have learnt in paragraph number 6, seasonal occasional revenue will be recognized in the respective quarter only. It will not be allocated to other quarters. Point number 7, a major repair is planned of the plant in the fourth quarter, which is absolutely certain. The estimated repair expenditure will be accounted for in the first quarter only. Is it correct? So why it is not correct? Write down, there is no present obligation, no past event. Hence, no provision will be recognized. No present obligation, no past event, no liability. No liability. Any planned event in future, we don't provide for it, because that plan can always undergo a change. Then last point number 8. Over the year, the client has been unfailingly means every year, without fail, giving bonus to staff in the third quarter. Third quarter, because in third quarter there are a lot of festivals. Dashera, Diwali, okay, Bhai Dooj. This has become its constructive obligation. Constructive obligation means even though it is not a legal obligation, but because you have created an expectation in the mind of the staff that they are going to get the bonus every year, you have to pay it. You cannot avoid it. You cannot say that this year we will not pay. It will hamper your relationship with the staff. Why bonus is paid to the staff? Because he has rendered service for the entire year. Although the payment is made on a particular day in the year, but it is not for that day. It is for the services rendered during the entire period. Service for the period. This reminds me of share-based payment also. You get the share-based payment reward for rendering service during vesting period, and therefore we recognize it over the vesting period. Same goes with bonus to employee also. So the client does not wish to charge a proportionate amount of bonus in the current quarter. Can he do that? No. We are getting services for the entire year. So therefore we must apportion the bonus over the period of service rendered. So we should charge. So the answer is it should be charged in the current quarter. The benefit of expense should be spread over 4 quarters in this example. Okay. So it's an employee benefit cost. So this important question we have discussed. Now next is change in accounting policy. Can we change the accounting policy? Yes. When can we change accounting policy? Go to Ind AS 8. Ind AS 8, change in accounting policy can be allowed on 2 occasions. When Ind AS changes, change in Ind AS, and in case if the management thinks change would result into more relevant and reliable presentation. Relevant and reliable presentation. So assuming one of those two are satisfied. And you have also learnt in Ind AS 8, change in accounting policy will be given retrospective effect unless the transitional provision of an standard requires otherwise. Okay, keep that in mind. And now tell me, if there is a change in accounting policy, will you give retrospective effect? Yes. The prior interim period of the current period will be adjusted. And not only that, the comparative periods that you present shall also be restated. The comparative period shall also be restated. So if you are giving current quarter figure and same quarter in the previous year, even that will be restated. If you are giving 6 months information of current year and 6 month information of the previous year, first 6 months of previous year, that will also be restated. Now some question answer session will begin. Question number 11. ASF India Limited has 1,02,000 rupees net income for the quarter ended 31st December 2023, including the following items. Rupees 60,000 gain on sale of investment. We are in which quarter? Third quarter, 31st December. Okay. Rupees 60,000 gain on sale of investment received on 30th July 2023 was allocated equally to second, third and fourth quarter of financial year 2023-24. 60,000 they have a portion in second, third and fourth. So 2020, correct? When should this income be recognized? This gain on sale of investment should have been recognized fully in which quarter? The second quarter only. But they have recognized 2020 in second, third and fourth quarter. So what I'll do, this 1,02,000 rupees includes the gain on sale of investment 20,000, which should have been charged to or recognized in quarter 2 only. So will this adjustment increase my income or reduce my income? Reduce. So take one on your calculator, 1,02,000 and minus 20,000. 20,000 should have been recognized in second quarter only. It has wrongly got added to the third quarter. This you tell me. This is based on accounting policy, so I took this problem. Rupees 16,000 cumulative effect loss resulting from change in method of inventory valuation method was recognized on November 2, 2023. Out of this loss, 10,000 relates to previous quarter. So you should have recognized a loss of only 6,000, but you have recognized 16,000. As you have learned today, change in method of accounting, change in accounting policy. Inventory valuation method is an accounting policy. Okay, will be given retrospective effect, but you have given prospective effect only. So transfer 10,000 to previous quarter loss. So my this income will increase by 10,000. If I remove this loss of 10,000, my income will increase by 10,000 at 10,000. Added. So what is the status right now? 90? Sure. Okay, 92,000. In my presentation, I have not written here 20 less. So 1,02,000 minus 20,000 here plus 10,000. The answer is 92,000. Your answer is right. 92,000. And note, it is also required to restate the previous quarter based on the above adjustments. Question number 12. ASF Limited shows the net profit of rupees 5,40,000 for quarter 3. Type 5,40,000 on your calculator. After incorporating the following: bad debt of rupees 30,000 incurred during the year. Write down during the quarter. Bad debt of 50,000, 30,000 incurred during the, it is written year here. You make it quarter. Wrong drafting of question. Quarter. 50% of the bad debts have been deferred to the next quarter. Right or wrong? Wrong. What is wrong? Entire 30,000 should be recognized in the quarter 3 only. So 50% of 30,000, 15,000 only they have charged in the third quarter, and 15,000 they have postponed to the next quarter. Can you do it? No. Had you charged entire 30,000 in the third quarter, your profit would have been lower or higher? Lower. So how much lower? 15,000. Take 5,40,000 minus 15,000. 5,25,000. So after this adjustment, my revised profit is 525. Then one more adjustment: loss on sale of investment of rupees 28,000 incurred during the quarter has been fully recognized in this quarter. Right. No adjustment. Every time you don't have to adjust. It is correct. Ignore. This is right. Additional depreciation of rupees 36,000 resulting from the change in method of depreciation. Change in method of depreciation is a change in accounting estimate. Prospective effect. Should it be recognized in this quarter only? Yes. Have they recognized in this quarter only? Yes. So what is the mistake? No mistake. Again ignore. Now what is your answer on calculator? That is the answer. Do you agree with the treatment adopted by the company? So in the exam you will write, we do not agree with the first adjustment, but we agree with the second and third adjustment. And if not, find out the correct quarterly income. So as you rightly said, the answer is 5,25,000. That is printed in your notes somewhere below. Either you can prepare a P&L account and then show it, or you can write a note. Write in as much detail as you can. Okay. Whatever maximum detail you can write. Right. Now again some theory and then again some questions will start for you. Minimum component of an interim financial report. What is minimum component? That is required for condensed financial statement. Okay. For complete financial statement, you can give all the possible details that you give in annual report. An entity can prepare, you are allowed to prepare a complete set of financial statement, which means same like annual report with all the details, all the disclosures, all the presentation followed, or it can be a condensed set of financial statement, means limited information. Condensed set of financial statement means only minimum information that you are required to give. Why the IFR allows you to give condensed set of financial statement? For two strong reasons. One is the timeliness. If you prepare complete set of financial statement, then the compilation of the entire data, presenting it, will take a lot of time, as you are aware. And if you take so much time to prepare and then dispatch the financial statement, by the time the first quarter statement is dispatched, second quarter is also over. Sometimes third is also over. So what is the use now? No use. Second reason for giving condensed statement is cost consideration. Preparing a complete set of financial statement means huge cost is involved, both accounting, auditing, legal, consultancy. You have to take the help of actuary every time. If you go for complete set of statement, you have to do lot of estimation every time. That requires cost. And third is to avoid repetition of information which is already reported in the annual report. Many times you will find the same information which was there in the last year is applicable for this year. Example, accounting policy note. Okay. You can take the annual report of 2 years of a company. They just same copy and paste, which you are champions. Yes or no? You also do the same thing. Many times you don't even read also what was written in the last year. You read full thing. Good. But such people are rare. An entity may be required to or may elect to provide less information at interim dates as compared to annual reports. So three reasons they are mentioned in the standard: timeliness, cost, and unnecessary repetition of the same information. Now, if they ask you what are the minimum components of an interim financial report, 5 components are there as usual. One is called condensed statement of financial position or balance sheet. Statement of financial position is called balance sheet. You write SOFP here. Second is statement of changes in equity. Statement of changes in equity. Statement of changes in equity. Third is condensed statement of profit and loss. Fourth is condensed statement of cash flow. And fifth is selected explanatory notes. So that means the detailing can be reduced. Condensed means less details. Example, suppose in annual report you write share capital, and then you also write authorized, issued, subscribed, paid up, calls in arrear from directors, calls in arrear from others, shares issued without consideration, shares issued as bonus shares. Are you supposed to give the same detail here also? No, unless there is a change in the share capital. Second example for inventory. In annual report you write inventory and bifurcated into various types of inventory: raw material, WIP, finished goods, stores and spare packaging material. Here you can just write inventory, just inventory total. So that is called selected explanatory, condensed statement. What do you mean by selected explanatory note? Again, the notes to account, only some selected data will be given, selected information. Everything that you give in notes to account in annual report is not required. For example, annual accounting policy details are not required unless there is a change in accounting policy. Okay. Then disclosures required under many standards are also reduced. If there is no change, those can be avoided, because the objective is to give the information as early as possible. So what do you mean by condensed set of financial statement? Para 10, condensed set of financial statement would mean that we will give each heading and subtotal that were included in the most recent annual financial statement that was presented as a minimum. Take the annual report. See what are the main headings and subheadings you have given there. Those main heading and subheading you can give. For example, equity and liability. Main heading. Under that we have 2 or 3 headings. Equity, non-current liability, current liability. So that is minimum you have to give. More than that is always welcome. You are also allowed to add any line item also. If you think that inclusion of that line item will make it more appropriate or exclusion can be misleading, so any additional line item can also be included if excluding them will make the financial statement misleading. So a lot of freedom is given to you actually. The standard has given you minimum requirement, more than that is welcome, plus you can also add additional line items. Now paragraph 11, selected explanatory notes. First remember, this list is not exhaustive. This list is not exhaustive. This is, you can say, an illustrative list of what you have to disclose. Illustrative list. More than that is welcome. More is welcome. So what is the selected explanatory note? 1. Statement that same accounting policy and method of computation are followed as in the most recent annual financial statement. Now this is, I need to explain. Annual report already gives you all the accounting policy notes. Is it right? It runs into several pages also sometimes. For inventory, what is the accounting policy? For depreciation, what is the accounting policy? For goodwill, what is the accounting policy? For intangible asset, what is the accounting policy? For leases, what is the accounting policy? So every item in the financial statement, if they have followed some accounting policy for that, they give a disclosure. Do I need to give the same disclosure in the interim period also? The answer is no, if we have followed the same policy. You can simply give a reference that same accounting policies have been followed, which were followed in the most recent annual financial statement. So if somebody wants to know what was the accounting policy for depreciation or inventory or goodwill, you can just go to the annual report and check there. Of course, if you change the accounting policy, then all the disclosure requirement for change in accounting policy would become applicable. Understood? If your entity is into seasonal or cyclical business, seasonal operation or cyclicality of operation, you should give an explanatory comments so that your financial statement is not misleading. If you are a woolen garment company, first quarter there is a loss. It should not give an impression to the investor that it is a loss-making company, and therefore let us sell all the shares in this company and run out. Or if you are an air conditioner company, should not be giving an impression that it is a huge profit-making company, because every quarter will not have the same profit. So give an explanatory comment. Then nature and amount of items affecting asset, liability, income, equity, cash flow that are unusual. Any unusual transaction, report it separately. Nature and amount of changes in estimate. Estimates by their nature are likely to change. More likely in interim period, because in interim period we do not put lot of efforts to find the accurate information. We have less time. So maybe you have to give a disclosure about change in estimate between last year and first interim period. Between first interim period and second interim period, if the estimates have changed, give disclosure. And then you have to give disclosure about issuance, repurchase and repayment of debt and equity instrument. Understood? This is very important because this will affect debt equity ratio. This will affect a personal stakeholding in the company. This may increase or decrease the risk of being an investor in a company. This may show you whether the company is planning to expand further or company plans to reduce its activities. So these are important information. You have to give information about any dividend paid during interim period and segment information also if the entity is preparing segment report. What are the segment information that you have to disclose? Same that you disclose in the operating segment IFRS 8. Like for example, the most common disclosures in segment reports are revenue from external parties, inter-segment revenue, segment profit or loss, total asset with any material change, differences and reconciliation. Material events that are not reflected in the financial statement. So that you can disclose any material event. An effect of change of composition of equity. If there is any change in equity, like for example, issue of equity share, buyback of equity share. In case of consolidation, your stake in the subsidiary has increased or decreased. Non-controlling interest increased or decreased. Give an impact, give a disclosure. And as we have discussed in one other standard, IAS 37. What is IAS 37? Provision, contingent liability and contingent asset. If there is any change in contingent liability between last interim period and this interim period, disclose. Last financial year and this interim period, disclose. I have discussed on that day that contingent liability and contingent asset should be reviewed regularly. It is possible that a contingent liability may become actual liability. A contingent liability may no longer remain a contingent liability. So therefore those effects should be given because this can significantly affect the risk of the entity. Yes, impairment also. Even if there is an impairment, first in case of some item there is mandatory requirement. So that is annual requirement. So once in a period you have to do. Yeah, once in a year. Once in a year. And you have to choose when you want to review it. So if you decide to review, annual reporting. Annual. We'll check it after the break. Okay. In case of impairment, her query is it required to be tested each reporting date? So just check the wording. To my understanding, it is once in a year. Annual. Impairment testing will be done annually. Something like that is mentioned in your IAS 36. So you can do it once in one of the quarters. You can do that impairment testing, and then every year you have to follow the consistency. What about the role of estimates? First of all, which standard discusses about estimate in IAS 8? IAS 8. Name of the standard also have that word estimate in it. Estimates are made so that you can finalize your books of account. You don't have accurate information every time. So therefore we are allowed to make the estimate. Estimate should be reasonable, which should be best estimate, blah, blah, blah. Can we change the estimate? Yes. My question is, when do we make more estimate? In interim period or annual period? Why? At least in annual period we are given more time so that we can have a more information. We can take the help of an actuary. For actuarial valuation we can give him some time, but that is not possible for interim period. Similarly, for making warranty provisions, guarantee provisions, here we have less time. So normally here we rely more on estimates. Estimates will change. What you have to do, you have to give disclosures in the interim period whenever there is a change in estimate. Okay, so that was about estimate, not a very important paragraph. Paragraph 13 now. This is important. I'm going to give you two questions also below that to test your knowledge. Ready for the show? What are the interim financial reports you are going to give for the interim period? And what are the interim financial report you will give as comparative? As you have studied that we have to give comparative so that the users can compare the current data with previous data and he can take a more informed decision. He can understand the trend, pattern, growth, risk. So first is SOFP, component of financial statement for interim period at the end of the current interim period. And for comparative purpose, comparative SOFP at the end of the immediately preceding financial year. Okay. Only two. Current period. Suppose current period is ending on 30th September. So SOFP as at 30th September and SOFP as at 31st March. What about SOPL and OCI, statement of P&L account and OCI? Now here we have to give for this year, current interim period. Current interim period, let us assume our current interim period is 1st July to 30th September. 1st July to 30th September 2020. Okay, 2020. So one will be SOPL and OCI for 3 months ended 30th September 2020, and one will be cumulative for the current financial year to date, which means 6 months ended 30th September 2020, that is 1st April to 30th September, and comparative will be same period previous financial year. So in our example, it will be 3 months ended 30th September 2019 and 6 months ended 30th September 2019. Okay. So we'll assume we are in 2020 right now. What about cash flow statement? Cumulative for the current financial year to date. Here directly, suppose my quarter is 30th September. I will give the cash flow statement from 1st April to 30th September. We are not going to give 3 months cash flow statement. Same thing for comparative also. That is covering 6 month period ending up to the date of interim period reporting date. What about statement of changes in equity? Same like cash flow statement, cumulative for the current financial year to date. Means 6 month ended or covering 6 months period. And if you are preparing on say 31st December, then it will be 9 months ended for 9 months. If you are preparing on 30th June, then it will cover 3 months period. And same thing for previous year also. If our quarter is ending on 30th September, the previous year will be 6 month covering 1st April to 30th September 2019. But there is one more line here for seasonal enterprises. Those who are into seasonal business. In order to make the financial statement more understandable, not misleading, they are encouraged. What do you mean by encouraged? Below, not mandatory. They can give financial statement which will cover 12 months period. One full 12 months period ending on the interim reporting date. So it means in case of profit and loss, we have to give a 12 months P&L account ending on 30th September 2020. We'll have to give a 12 months P&L account ending on 30th September 2019 for comparison. And about the SOFP, we have to give a SOFP as at 30th September 2019. Same date, previous year. So 3 SOFP you have to give. If you are a seasonal enterprise, if you are a seasonal enterprise, then 2 more profit and loss you have to give. 12 months ended, 12 months ended. 2 more cash flow statement. 12 months ended, 12 months ended. 2 more SOCIE. 12 months ended, 12 months ended. Is it mandatory? No. There is a note in the book. In case of highly seasonal businesses, the enterprise is encouraged to give financial information for 12 months period ending on interim period date and corresponding 12 months ending in the previous year. So that is to make the financial statement more understandable and comparable. Because 12 months period will cover the whole cycle, which will cover period of high sales and low sales also. Now we will take a break. During break, you can try question number 13 and 14.